Good morning, everyone. Welcome to CPA Canada's webinar on the 2022 federal budget tax highlights. We're so pleased you could join us today. My name is Vivian Leung, and I'm the Senior Principal of Tax for CPA Canada. I work with a team of tax professionals who are dedicated to acting in the public interest, developing an equitable, effective, and efficient tax system in Canada, and delivering practical information and fresh perspectives on tax to members and the broader tax community. Joining me today is Bruce Ball, our VP of Tax at CPA Canada. Bruce has been leading the work of our tax team since 2017. Prior to this role, he was a national tax partner for BDO Canada and head of the firm's national tax department. Bruce is going to be providing us with an overview of some of the key tax changes that were announced in yesterday's federal budget. He's going to walk us through CPA Canada's tax highlights summary that was published and posted early this morning to our website. The summary was also emailed out to our tax blog reader list this morning. Unfortunately, we won't be able to address live questions today, just given the size of our audience and time limitations. We know there are many questions and issues that arise from the budget, so we'll be following up with the federal government on many of these issues, and we'll provide updates on our tax news page on any developments as we move forward. So without further ado, I'm going to turn things over to Bruce, who's going to present us the main tax measures that were announced in yesterday's budget. Over to you, Bruce.
Thanks, Vivian, and good morning, everyone. So welcome to our first post-budget webinar. So we're really happy that we can put this on for you this morning. So I wanted to talk just a couple of things to keep in mind as we go through it. We'll be providing an overview. I don't know to what extent everyone's had a chance to look at the budget papers, but for some of the things that we're going to talk about today, there actually is a lot of detail in there. So we're only going to be able to provide you with an overview today, but we're going to try and highlight, I think, what are the key things that are in there. And if something is of interest, then it'll highlight something for you to go have maybe a more detailed look at. The other thing, I might say this is going to change or that kind of thing. Obviously, everything in here is a proposal at this point, so I may not say proposed every time I talk about a change, but just keep in mind everything is a proposal until legislation's brought forward and passed. So on that note, I'm going to get right into things. What we're doing is we're going to follow along with the tax highlights summary that we posted to the CPA Canada site earlier today. So I'll be following the framework of the report. I'll be adding a little bit in as we go along too, but the basics are in our tax highlight summary as well. So that'll give you some initial information. Like I say, the best place to go if you want more detail is the budget papers. The other thing I'll try and remember to highlight is some of the changes were mixed into other parts of the budget. They're not all in the tax annex. So if you're wondering where something came from, there's a good chance it's a more general thing that they're working on, and it's in other places inside the budget papers. So just to highlight that as well. So it was an interesting budget. There were, I think, a few surprises. We'll highlight those when we go through them. We're going to start with the business tax changes first. And the first one is a bit of a surprise. I don't think we saw this one coming, although people have been talking about this issue for years. So it's the rules for Canadian controlled private corporations that are eligible for the small business deduction. They get the reduced rate on the first 500,000 of qualifying active business income. Now, there's a couple of phase outs. Now, one of them has been for years a phase out based on taxable capital the previous years. So the small business limits phased out once a corporation or an associate group's taxable capital exceeds 10 million, and then it's completely gone essentially at 15 million of taxable capital. So this is something that's been around for a while, but it's never been indexed. So the impact each year has been getting, I think, more and more severe as businesses get larger and, just inflation. The amount of taxable capital in medium-sized businesses has gotten larger over time, just as a real matter of evolution more than anything. So there's a really welcome change here. Although the 10 million limit isn't going to go up, they've increased the upper limit from 15 million to 50 million. So essentially what that'll do is lessen the impact if you do go over the $1 million of taxable capital. So that is a welcome change. It's going to apply for taxation years that begin after on or after budget day. So that's as of yesterday. And like I say, this is a change that some groups have definitely been asking for. So it's a welcome change. I'm going to highlight next just some changes that relate to the environment. So there were a few changes here in terms of tax. And probably the biggest change is the second bullet, which is the investment tax credit for carbon capture, utilization, and storage. It's a pretty large credit. There are 3 layers to it, essentially, depending on how direct, I suppose, the investment is. So if you have eligible equipment that's used in a direct air capture project, as an example, the credit there is 60%. And there's a median one, or a middle range for other capture equipment of 50%, and then more secondary equipment, storage, and transportation, that sort of thing, 37.5%. So pretty substantial credits. They'll apply basically from 2022 through 2030 at those rates, and then they get cut in half for 2031 to 2040. So this all begins effective January 1st, 2022 in terms of this credit. So a fairly significant change there. The next item on here, and this is one of those ones where it's elsewhere in the budget document, I believe. It's not one of the ones in the annex. So there was another proposal for a new investment tax credit for clean energy. So this will apply to situations, and it's more of a proposal at this point. It's sort of in that sort of initial stage as opposed to something more detailed that's in the annex. But the idea is that it'll focus on net zero technologies, battery storage solutions, and clean hydrogen. So the idea here really is to provide an additional incentive for things that are environmentally friendly. So again, something that was put out in the budget papers. They're going to do some more consultation, and the idea is that they're going to present some more information this fall in the economic update. Another one along the same lines is the clean technology tax incentives. These are changes to capital cost allowance classes 43.1 and 43.2. And they're going to add air source heat pumps after April 7th to that, to those capital cost allowance classes. The other change here is they'll also broaden the zero emission technology M&P activity reduction, tax reduction that was proposed in last year's budget. So again, those activities will be added here. Another change, and this is again, these are very targeted. You can see as we go through these. Another change is something they've referred to as the critical mineral exploration tax credit. And essentially these credits are aimed at minerals that are used in products such as zero emission vehicles like batteries, magnets, that kind of thing. So it's targeted at those sorts of minerals. The idea here is it'll be a 30% credit, and it'll be a flow through share arrangement. So in other words, as the expenses incurred, the corporation incurring them would be able to renounce the expense and essentially flow it through to the shareholders of the flow through issue. So this will start with flow through agreements that are entered into April 7th and 2022 and before April 1st, 2027. Now, I guess one other change in the flow through area, this is the flip side with a focus on clean energy. They will be ending the flow through share arrangements for more traditional energy sources being the oil, gas, and coal activities. So those flow through share issues of land. Essentially, this change will start at the end of March next year. So you'd be able to issue new arrangements, but then it will essentially cease at that point. There were also some changes for financial institutions. This is probably the worst kept secret, I guess, in the budget, because they've been talking about this one for quite a while now. But it was different than what was proposed or what was being discussed, I guess, pre-budget. So the budget papers proposed two measures. So one of them was a tax increase for banking and life insurance groups. So it'll bring the corporate tax rate from 15% up to 16.5%. Now there would be an exemption on the first 100 million. So it's a lesser impact, I guess, rate-wise at any rate. On taxable income. The original proposal was 3%, so it's lower than the number that was being kicked around before the budget. The other piece that had been talked about is the Canada Recovery Dividend. So that's a 15% one-time tax on taxable income over $1 billion. So in this case, the financial institution would calculate income for 2021, and if it's over $1 billion, then this 15% tax will be payable on that. There was another change as well for financial institutions in terms of hedging and short selling arrangements. Some rules were added to deal with that planning as well, and we won't get into that in detail. The second bullet here was an update on Bill C-208. So for those of you that are following it, you probably know this well, but just as a bit of a quick recap, the issue here is that the rules for the capital gains exemption and capital gains treatment versus dividend treatment, that sort of thing, it worked well for arm's length sales, but if you had a commercial transaction within a family, it didn't work well. And Bill C-208, excuse me, tried to correct that. And I think it largely did. I think the concern, though, from the government's perspective was that it may have opened up things too much in terms of planning that didn't involve what I'd call a genuine commercial sale. It might open up the possibility for other things. So the government announced last summer and an update in the fall just to say that they were working on a more, I guess, a solution that builds more protection into the tax system in terms of maybe more artificial transactions. So no new news there really, other than that they will be doing a consultation, and the plan is to do the consultation, and the consultation will close June 17th, and then they'll introduce tax legislation later in the year. So we will be seeing more of an update as the year goes on. Now, again, a few more changes that were sort of in this more preliminary stage. They've been put out more from a sort of a concept point of view at this point. So again, these were referred to in other parts of the budget papers generally, but they're going to do a review of the scientific research and experimental development rules. So the idea here is to just make sure that the program is working effectively and look at eligibility criteria in particular. I know a lot of organizations have been asking for the next one, which is to have a patent box. They haven't committed themselves, but they have said that they will consider and seek the views of on the suitability of adopting a patent box regime in Canada. This is essentially where if you have intellectual property, you'll be allowed to be taxed at a lower rate on profits that emerge from that IP. Another thing that they talked about is looking at a rollover for small business investments. We think they're talking about the rules that allow you to defer capital gains, where you sell one investment and acquire another one. So we'll have to see what details emerge as we move forward. And another thing that they were looking at in the past year or so were employee ownership trusts. So the idea was trying to find a way to set up a trust that could hold shares for the benefit of employees. And I think they've concluded essentially that the current trust rules don't really have what they think is needed to promote this. So they'll be introducing a new concept of an employee ownership trust. So again, this is something that we'll see emerge, I think, over the course of the year. They will continue to engage with stakeholders as they move forward with this. Now, there were several changes on personal front as well. We've grouped some together here because they're related to the ownership of homes. There were a few different ones here, 4 good ones, and maybe number 5 not so good, depending on how you've been buying and selling real estate, I suppose. The first one's really the biggest one, and it's been talked about a lot too. And to be honest, I wasn't quite sure where the government was coming from, because it sounded like a different version of tax-free savings account. So turns out it really isn't. This is something different. It's almost a hybrid of RRSPs and TFSAs at the same time. So this is the tax-free first home savings account. And we think it'll probably be coming in 2023 sometime. There was reference in the budget papers to having to work with financial institutions to get them up and going. So it will take some time before they become available. But it's an interesting concept. So the idea is at the front end, it's almost like an RRSP. You can put money into it and get a deduction. But at the back end, it's like a TFSA. If you take the money out and use it to buy a home and meet conditions, there's always conditions with these plans, but essentially, if you take the money out to buy a home, it'll be a tax-free withdrawal. And the income that accumulates in the plan will also be tax-free when it comes out, provided, again, it's used to buy a home. Now, there are a lot of details, so we'll just highlight a few of them. The contribution limit is 40,000 in total. So that's a cumulative limit. The most you can put in any year is $8,000, and that is not a limit that can be carried over. Now, you have time to make up for a contribution that you don't make in a year, but you can't carry forward an unused one and sort of catch up sort of retroactively kind of thing. So it's 8,000 a year, but no carry forward on that. The plan itself can last for 15 years, but at that point, it essentially gets terminated. So the money would come out as a tax. If it comes out, I suppose, right on the last day when you buy something, it'll come out tax-free, but otherwise it'll come out as a taxable amount at the end. Now, there are rules as well for transfers between RRSPs and registered retirement income funds as well. We'll have to see how all this works out, but it does look like there's some flexibility in terms of transfers either to or from RRSPs and RRIFs. So I think that may also that might help increase the interest in these plans too, with the ability to access or transfer to an RRSP. Now, there was one thing that they mentioned as well. They aren't changing the home buyers plan, but they did say that you can't do both of them. So if you choose one, you can't do the other kind of thing. So that'll be something to keep in mind as well. So there were some other changes on home ownership that we wanted to highlight as well. And the next one is the first-time home buyers tax credit. They've doubled that. So the credit amount's going up to $10,000, which means that you can get a maximum credit of $1,500. So that applies for 2022. The home accessibility tax credit has also been increased. The budget is going to again double that credit amount as well to 20,000. So that would give you a maximum credit of up to 3,000. So again, that's effective for 2022. The next one, this might certainly create a fair bit of interest. We had one question today, and we'll deal with that at the end. But it is the multi-generational home renovation tax credit. So that's a fairly substantial tax credit for those that will qualify. It's there are a lot of rules. I think it was 2 or 3 pages in the budget papers with all the details, but it's at a really basic level. The idea is that you could buy, or you could create a secondary unit inside a home for a senior or an adult with disabilities, and the amount of eligible costs that can be claimed is up to 50,000. So as a $7,500 credit at 15%, that is one of the, that might be very well the largest tax credit that's possible, actually, because that's a really sizable credit amount. So this one's, though, not going to start until 2023, generally speaking. So we'll have to wait a little bit before we can start accessing that. But like I say, there are a fair number of details. So this will be something, I think, for those that are interested to really go through the details and see what makes sense for them. Now, it wasn't all good news, I guess, on housing. Depends on how you look at it in terms of housing prices. Perhaps this flipping rule that they have announced will help. For those that we're doing more short-term transactions, this will be something they have to watch out for sure. So the idea here is that the government was not happy with the idea that people would buy a home and then quickly turn around and sell it again and have a gain on it. It could be a situation, I suppose, where you just buy it and sell again quickly, or you may actually do improvements and sell it, I suppose. Either way, though, it looks as though the rule would apply more or less the same way. Essentially, what they're going to do is they're going to say that if you held it for less than 12 months, we're going to assume and deem you to have had an income gain to the extent you do have a gain. So the idea is if you buy a house and sell it in 8 months, if you have a gain on the property, it'll be deemed to be business income, essentially. Now, they have recognized that there are reasons why individuals have to sell homes shortly after they buy them. So they are going to put in exemptions for what I'd call life events in case of death, disability, the birth of a child, a new job, or separation in terms of a marriage breakdown. So there, like I say, there had been a fair bit of speculation going into this, pardon the pun, but we do know that they plan to proceed with this. Now, they did say that they will be doing a consultation, so there will be a chance to give the government feedback. And we didn't see an effective date for this as yet, so I guess that'll be based on feedback from the consultation that they do. A few other changes for individuals. There's a new deduction. It's they've referred to it as a labor mobility deduction for tradespeople. The government is proposing here to allow a deduction of up to $4,000 of eligible travel costs and temporary relocation expenses for eligible tradespersons and apprentices. So that's a new deduction coming forward. Another change is an adjustment to the medical expense credit for surrogacy and other expenses, such as expenses of a surrogate mother, fees paid to fertility clinics, donor banks, a wide variety of expenses that might be incurred there. So they are expanding those rules out. And the last one that was referred to, again, there wasn't a lot of detail other than just a reference that they're going to provide an update in the 2022 fall economic update. So this fall's update. They're still talking about a minimum tax for high income earners. If you're like me, you're still puzzled, I suppose, because we already do have an alternative minimum tax. So I'm assuming, I don't want to speak for CPA Canada because we don't know, but I'm guessing that we're talking about adjusting the alternative minimum tax. It does seem it would be strange, I suppose, to have two minimum taxes operating at the same time. So I guess my personal assumption is that they're probably looking at working on the existing AMT rules, but we'll have to see. Like I say, there hasn't been a lot of detail provided so far. Just on the international front, and we had a few other tax changes. We kind of just lumped them together in our report. There was a lengthy commentary in the budget papers on the OECD Pillar 1, Pillar 2 process and an update on that. Pillar 1 deals with taxing rates, and it's had a significant sort of emphasis on digital and of course, the proposed digital services tax. It hasn't quite made it through yet, but the final digital services tax is meant to sort of be an add-on to that. They did say the plan is still the same there. The digital services tax will kick in if the OECD process doesn't go through, and it'll apply back on a 2-year retroactive basis. So there's no change on the plan for the digital services tax. On Pillar 2, there was a lot of information there too. This is the global minimum tax for corporations. I think the big takeaway I had, and maybe it's because we'll have to work on something, is there's a consultation that ends on July 7th, 2022. But there was a fair bit of other detail in the report, and the consultation discussion in the budget papers was pretty detailed as well. So for those interested, there's a really a thorough update on where we stand right now with all of the OECD Pillar 1, Pillar 2 negotiations and the work that's being done. There were a couple of other international changes as well. The government plans to go ahead with another OECD initiative. This is the OECD's created model rules for reporting by digital platform operators. So the Canadian government will be implementing rules around that using the OECD model as a guide. So this will be in development for a bit. It won't be happening until after 2023, but those rules will be coming. And there was a change on withholding taxes. So this would be a situation where you have bond coupons, so coupon stripping arrangements. The government's going to implement rules there as well. It's generally effective budget day, but there is a transitional rule as well. Another fairly significant item here, and it's a two-part update on the general anti-avoidance rule, but there are two issues happening here in terms of the GAR. First is a change on tax attributes. So it's interesting if you think about it. If you have a transaction and it immediately either increases a tax deduction or provides an immediate reduction of taxes as a credit or some other amount, GAR applies at the point of time of the transaction if it has an immediate impact. But the government was concerned that situations might arise where they might want to apply the general anti-avoidance rule, but the planning that they're after, or the transaction that they're after, creates tax attributes that aren't used immediately. In that sort of situation, the government would need to wait until someone actually tries to apply the tax attribute and then try to proceed with a GAR assessment at that point. And they've decided that they'd much rather deal with it at the time of the transaction. So essentially, this proposed change would give the government the ability to adjust the tax attributes at the time and not wait for them to actually be applied. The other part's more general. There has been discussion for the past year or so about a GAR review, and they've highlighted again that they do plan to do it. The plan is over the summer in terms of releasing a paper and doing a consultations. And the idea, they say, is to have new legislation by the end of 2022. So we'll see. We'll have to watch as this develops as well. But there will be changes coming on the general anti-avoidance rule more generally. Few other changes we wanted to highlight. They just sort of a few other things that didn't fit nicely somewhere else. For charities, there's a relatively major change here, I think. They'll know better than I will in terms of the impact it'll have, but they are increasing the disbursement quota from 3.5% to 5%. And there'll be some other administrative changes as well. So anyone involved with the charity will want to have a look at that. There's also a discussion on improving the rules for charitable partnerships, and there's more in the budget on that as well. Another interesting one we wanted to highlight that's in the tax highlight report is a new rule that'll require financial institutions to report the fair market value of RRSPs and RRIFs that they administer. They say for tax administration purposes, I believe, I'm sure the intention here is to see the fair market value compared probably with a record of what contributions that an individual's made. And similar, I think, to work they did on TFSAs, probably to take a look to see if they think to try to understand, I guess, if there has been a large increase between contributions and the current fair market value, where that came from. So it sounds like they'll be doing more work on RSPs in the future. The last thing I'll highlight, and there was about a page and a half, I think, in the budget document, there is a fairly lengthy list of items that the government still needs to follow up on. We didn't do a confirmation or a reconciliation, but it looks like just about everything that was on the go before is still on the go. They didn't provide much detail in terms of where things are going, though, in terms of these items. It was just to highlight that they do intend to go forward with them. I think one of the concerns that we're worried about, actually, in terms of the previous announced changes, the Joint Committee's been actively working on the new interest deductibility rules, and we're a bit concerned on timing on that. So we were hoping that there might have been a bit of a heads up on timing for those rules, but we're a little concerned that whether there'll be enough implementation time. So that is one of the things that we do follow up with government on, is just to remind them that we do need time for some of these things. And on GST, HST, we highlighted a few things toward the end of the report. They were, I think, all very specific sorts of changes. They'd affect nurse practitioners, as an example. So they expanded the healthcare rebate for that in terms of geographical restrictions. They've also changed the rules for assignment sales of newly constructed or substantially renovated residential housing. So again, a fairly directed rule there. And they also are changing some of the rules around vaping products and cannabis products as well. So, I wouldn't say major changes, but excuse me, some changes in some specific areas that for those involved there will want to take a look at. And on that note, I think that's our walkthrough of the rules. Vivian, I think we did have a question or two, but we also wanted to just walk through some of the key takeaways, I think, that we found last night when we were working on the report.
That's right. Thanks, Bruce. I think that was a really good overview of everything that was contained in the budget papers. We did, as Bruce just mentioned, we did receive a question right before the session, and it kind of just highlights the need for us and for many of us to kind of work through the details of all the rules that were put out yesterday and follow up on a number of outstanding questions that we have. The question that we received was what the impact of the multi-generational home renovation credit would have on the principal residence exemption. And I think, when Bruce and I saw that, that is a really important question. It's, again, just an example of something that we'll have to work through in the coming weeks and months. So we'll be following up on that. Bruce highlighted, I guess, the key measures that were introduced yesterday, but I think might be worthwhile highlighting some of the changes that were anticipated but didn't actually make its way into the budget. The one thing I think many anticipate almost every year before the budget is that it might be the year that the government actually changes the capital gains inclusion rate. But I can tell you that that didn't happen this year again. It's still at 50%. The other change that many were speculating on relates to tax rate hikes. And apart from the banks and insurance groups that Bruce mentioned earlier, there are no personal or corporate tax rate increases for this year. On the banking and insurance tax increase, that's just restricted to that sector and not the others that had been suggested prior to the budget. The one concern we have around that is choosing a specific sector to apply a tax increase on is worrisome, and hopefully that's not a trend we'll see coming in the future. Bruce, how about on your end? Are there any surprises that you had?
Yeah, Vivian, the one I am surprised on is I mentioned the Bill C-208 change. So, that's, as I was mentioning, issues around taxation of capital gains and the capital gains exemption when you want to do a transaction within family. The situation commonly is that the parent wants to sell to a child's holding company in the same way that you would with arm's length people. It works well from the perspective that, you can buy the shares and earn business income inside the target that you acquired and pay it up to the holding company and essentially use it to pay back the person that you bought the shares from. So I think we were surprised that we were assuming that it would have moved a little further along. So it'll be interesting to see how the consultations sort themselves out. So as with the other things that we've mentioned, hate to break it to you, Vivian, we got a lot of work to do, I think. So the word consultations used throughout the budget papers. So this is another one where we're going to have to do some work. So maybe I'll just highlight a few key takeaways from my perspective as well. One change in particular was the change for Canadian controlled private companies and the manipulation of CCPC status. That was it's a change that's there in the notifiable transaction proposals that or an issue that was in the notifiable transaction proposals that were released on February 4th, and it's in again in the budget. So these are situations where you there's a couple of different ones actually. So the one is where people have taken steps to use a private company that doesn't meet the Canadian controlled private company test. So the idea is that you're able to avoid the application of refundable taxes on property income. The idea of the refundable system is to bring the taxes on property income up to a rate that's essentially similar to what an individual pays, but then get it back later when you pay a dividend out to the individual as a shareholder. So the government is bringing forward some cases on that, but they also added the manipulation of private company status as one of the notifiable transactions in the February 4th draft legislation. So that is being taken care of there. That's effective basically for taxation years ending after the budget, on or after budget day. I think the main thing, though, I take from that those transactions is a more typical maybe M&A transaction where a private company is being bought out by a public company or a non-resident because its status may change. It does appear that those rules will apply to that as well. There is a transitional rule that will provide relief for transactions that were already underway. So I think that's one key thing to watch for, is that rule if you're doing a transaction. The small business deduction change, that is welcome. I have to say, though, maybe a tiny bit disappointing, because I think some organizations were suggesting that the 10 million maybe could have been increased as well. The 10 million threshold's been the same since the introduction of the rules. So I think that's a key takeaway, that the impact of these rules will be lessened, but I think it would have been helpful if they'd indexed the lower threshold as well. And I think the last big one in terms of businesses for me was, and individuals, but it seems to be more of a business issue, is the general anti-avoidance rule, and especially the review and the tax attribute application going forward. Also mentioned, like I said, for charities, they should really start thinking about how the disbursement quota is going to change on how they operate. Like we highlighted, it's going from 3.5% up to 5%.
Great.
Vivian, what did you think on for individuals?
Yeah, I think on the individual front, I know, again, leading up to the budget, many were anticipating that there were going to be a number of measures and enhancements to address the housing affordability situation in Canada. So I think, again, the main changes, I think the tax-free first time, sorry, we're going to have to get used to all these long names and acronyms, tax-free first home savings account, as well as the doubling of the first time home buyers tax credit. These, I think, are two, enhancements / new programs that are going to be really helpful for first time home buyers. So again, we'll have to keep an eye out as details are released on the first home savings account in particular. I think that's big. The other thing in my mind is really the flipping tax. Again, maybe bad news for some people. I think this is the government's way to hopefully try and also address the high housing prices. So we'll see if that has an impact on that. But I think those two are probably the biggest things on the individual front in my mind. Bruce, what do you, sorry, I was going to ask you, Bruce. Now that we've kind of talked about the specific measures, now that we've seen the budget, what do you think are the next steps for us here at CPA Canada? And maybe some final views from your side.
No, yeah, thanks, Vivian. Actually, maybe one quick thing on the first home savings account too. The one thing I worry about is the complexity in all these different plans, because we do know that some of the plans that they've introduced have been underused, and I do worry that maybe is it because people don't know it's available or don't understand it, I guess. So I think that's going to be an important step going forward too, is to try to highlight, in very clear terms for everybody how these will work as well. But anyway, yeah, that was another thought we didn't talk about before. Yeah, from our perspective, maybe we could talk about things that we would have liked to have seen, I suppose. We still think it's important to do a tax review. We're looking at this two different ways, I guess, the past year. So I mean, we still believe that a general review of the tax system would be a good idea, but we've been realistic to take into account that we have been in a minority government, and chances of a review during that aren't as good. One thing we've been focused on more lately, and I think it does tie in to some of the things we saw in the budget, we do want the government to do a more focused review on tax expenditures. We did a paper that's on our website, just sort of highlighting what we think the issues are. I think sometimes tax expenditures aren't sort of given the consideration they should be, because they result in a reduction of revenue to the government, which has the same impact on a deficit as something that's actually spent. So, as money that isn't available for other things, we do think that it's important to review these tax expenditures to make sure they're both efficient and effective. So efficient meaning that they don't cause more problems than they're worth, I suppose, in terms of application. And effective from the perspective, is a tax credit or a tax deduction the best way to deal with an issue as opposed to some other approach? So we would strongly encourage the government to do a tax expenditure review. And I think on both of the things that I just talked about, the House of Commons Finance Committee is essentially on the same page. They also have talked about the need for a tax review, and they have talked about a tax expenditure review as well. So we're hoping that'll be considered going forward. And the other thing I think for us is there's a lot of potential changes coming up where details haven't been presented, or a very specific consultation, such as the Pillar 2 consultation that's coming as well. So there'll be, I think, a continuing amount of change going on in the tax area. So no lack of things for us to do, but also it'll be important for taxpayers and their advisors to keep up with everything that's going on as well.
Yeah, absolutely. I think we were joking that a number of times we saw the word consultation in the budget was not a small number. So we will be busy going forward. So I think that wraps up our webinar for today. Bruce, if you wouldn't mind just jumping to the slide with some of our resources. We really do hope that today's session was helpful to you. You'll see on the slide here that Bruce has up on the screen. We've highlighted some of the key web pages that I definitely encourage you to check out, bookmark. The Canadian Tax News page in particular, that's where we tend to put most of our updates on any developments we have in our discussions with the government. We do try to put it on the Tax News page. So definitely check it out if you haven't, and bookmark it. As we mentioned at the beginning and throughout the presentation, we'll be following up with the government on a number of the significant budget measures, and we'll provide updates on this news page to keep you all informed. So thank you again for joining us today, and we hope you have a great day and a great weekend as well. Thanks, and bye-bye.